We're good. Good morning once again. I would like to welcome you all to this virtual press conference as BK Group Plc presents its Q2 and half-year 2022 financial results. My name is Bob Rutaringwa, and I will be your moderator for this virtual presser. I would like to thank you for joining us today and honoring our invitation. With us today is BK Group CEO, Mrs. Beata Habyarimana, and Bank of Kigali CEO, Dr. Diane Karusisi, as well as Chief Finance Officer Nathalie Mhaka, who will take us through the financial results. After the presentation, we will have a Q&A session, so please feel free to drop in your questions in the chat box. Now, without further ado, allow me to invite Group CEO, Mrs. Beata Habyarimana, for her opening remarks. Thank you.
Good morning. Very glad to have you for this virtual press conference. We are going to publish our financials. I'm glad to join you today as new Group CEO of BK Group since following the appointment of the Board of Directors on 1st of August 2022. We're also glad to see that we have a good growth with positive results. We are going to go into the details of that, and I will give the floor to the bank CEO.
Thank you, Beata. Good morning, everyone, and welcome to our press conference for our first half 2022. Most of you, I guess, have seen the press release where we announced a net income growth of 24.5%, which I believe is quite commendable. Overall, we've had a slow half when you look at the growth in the business top line. But the best news of the first half was improvement in asset quality, and this is reflecting post-COVID economic recovery. We're seeing hotels bouncing back with major events happening now and even in the first half. Rwanda, as you know, hosted CHOGM, the Commonwealth Head of Governments meeting. It was a very successful meeting. And following that major event, we've seen many more events coming back to Rwanda. So we are quite hopeful, despite the macro turbulences, inflation increasing. We have a very healthy pipeline for the second half, and we hope to meet our set targets for the year. So I'll let Nathalie, as usual, my colleague, to share the details, and I look forward to the Q&A. Thank you.
Thank you, Diane. Thank you, Beata. Good morning, and thank you for joining our press conference this morning. We are very pleased to release our first half result, and we are looking forward to receiving your comment on the same. When you look at our income statement, as Diane mentioned, net income, which is profit after tax, grew by 24.5%. That's very strong, and we are very pleased to see this, and we expect the second half to remain equally strong. And that was mostly driven by two things: the growth on the operating income, which was 5.5% year on year. You look at the challenging macroeconomic, globally, the challenging macroeconomic environment, delivering a growth in the first half of 5.5 is quite strong. So we are seeing some pressure on the interest rate and inflation rate. However, on the fees and commission, we remained, we saw new product coming in, and we managed to deliver over 20% in some key lines for fees and commissions. All our subsidiaries have contributed positively in the first half, and we are very optimistic to move forward into the second half. On OPEX, you recall that last year we implemented the new core banking system as part of our digital transformation strategy, and that meant some huge, post-implementation costs that came in, as you'll see in the details. Our OPEX increased, our operating costs increased by 32.9. There are many one-offs. There are also the fact that some COVID, the post-COVID activities have also resumed, things like traveling, conferences that were not there in the COVID time. So we see some one-off in first half that we expect to stabilize into second half. Hence the pressure on the cost, increasing our cost-to-income ratio. However, going on to the asset side, you will see that our total asset increased year on year by close to 17% to 1.6 trillion Rwandan francs. You have most of these assets being loans, which Jan mentioned earlier. We are seeing improved asset quality. That means our non-performing loans are currently at around 5.1, reducing from 6.6 that we had at the same time last year. You're looking at improved asset quality, which means any excess liquidity that we have, we're investing heavily on other securities like T-bills and bonds, and that you'll see in the details. But otherwise, our customer deposit also grew by close to 20%, and that is deposit we have from our client in current account, term deposits, and savings accounts. Our balances with other financial institutions also goes to supplement the pressure on liquidity. However, our total liability increased by 18.6%, with our shareholders' equity increasing by close to 10% to 96.5 billion. So we're very happy to see the first half we maintained our return on average asset at 3.5%. Compared to 3.6% full year 2021. And this is within our target, and ROE increasing, return on average equity that increased from 19.1 in 2021 to 19.5. Our target is to take this above 20%, with our earning per share now increasing to 62.7. We mentioned earlier that the macroeconomic environment are currently quite challenging, with rising rates in terms of depreciation of the Rwandan francs against the major currencies like the dollar but for the euro we saw some huge volatility. And for the in terms of exchange rate, when you look at our figures in Rwandan francs and Kenya shillings, we have 1,024 converted for the Kenya shillings rate at 8.7, so slight stability when you look at the KES, but for the USD we are looking at over 10% depreciation. On market share position, good performance in the banking sector overall. We are seeing especially the growth for the first half being strong from the result that the central bank has announced. We have the banking sector growing at close to 8%. When you look at BK, as we said, very slow first half. However, we are still, when you look at compounded, the past 5 years, we are still leading at 17.7% compounded annual growth rate, compared with 15.4 for the market. In terms of market share metric, we are very pleased to maintain 30% plus for all the key metrics. That's total assets, net loans at around 34%, and balances, client balances and deposit at 30%, and shareholders' equity at 32.4%. You look at our NIM also remain quite strong. It has reduced when you compare with prior years, but we talked about the challenges in the interest rate environment. We are still seeing our clients expecting us to deliver, to offer them good interest on customer deposit, interest rate on customer deposit, and we are quite challenged in terms of opportunities to increase our lending rate. So we are discussing with the banking sector. We are seeing the competition coming in with much lower rate on the lending side. And however, we are not too concerned when you look at the buffer that we had going into the current crisis with NIM above 10%. We expect to maintain the 9.5, 10% in the short term, going back into our 10% in the next couple of years. Cost to income ratio, as mentioned earlier, we are going back to the pre-COVID range at 40%. Our target is still to maintain this in the short to medium term within 40%. That will be mostly as we stabilize our post-go live for the core banking system, you know, as we stabilize the new core banking system and we phase out the current project that are currently putting pressure on the cost. In terms of asset quality, as discussed earlier, NPL at around 5.1, and we are very happy with our provisioning, you know, prudence. So we are holding about 130% provision for non-performing loan when you look at total provision against our NPL, and that is increasing from 124% that we're holding last year. In terms of subsidiary performance, as I mentioned previously, they've all had a very strong first half. BK General Insurance delivering close to 30% return on equity. BK Capital growing its asset under management strongly, and the BK Tech House creating more digital consumers around agriculture and the education ecosystem. And we expect to see more of that to come. The contribution of non-banking subsidiary to our profit is now close to 5%, and we are looking at, on the asset side, also for them to contribute significantly to the range of 10 to 15%. On key ratios, that on the last page, you have, we talked about NIM earlier and the pressure on increasing rates. So our loan yield currently, when you look at Q2, we had some catch up on Q1 with loan yield at 15.8. That was very positive, bringing our first half loan yield to 15.3%. Our cost of fund still elevated as of second quarter at 4.4. We want to see this come down to below 4%, and for the first half, it annualized at 4.1%, compared with 3.6 in the same period last year. On the liquidity side, we are quite comfortable with liquid assets at around 33%, and gross loan to total deposits now coming down to 91%, compared with 99.7 in the same period last year, and 92.6 at year end. We've touched on asset quality. On the capital adequacy ratio, we are well capitalized, growing it from 21% in FY21 into 22.7. That's total capital, core capital to total risk-weighted assets. And when you look at Npls Provision, we are increasing actually to 7.8 compared to 6.5 at year end. So we are taking additional provision, although we are feeling there's general improvement, and this is just to make sure that until things are fully stable in terms of post-COVID facilities and recovery, we will hold adequate provisioning. And when you look at, in terms of our operating data, we see some stability in terms of infrastructure investment. Number of employees remain constant, focusing mostly on IT and the DF resources. And in terms of number of branches, we are maintaining the same, investing more into digital channels as per strategy that has been communicated earlier. I thank you for your attention, and we'll open for Q&A. Thank you.
Thank you so much, Natalie, for the overview. Now, we're going to have a Q&A with the journalists that are online so far. And but before we start, some people are asking for a small overview in Kinyarwanda for the Kinyarwanda-speaking journalists. So allow me to invite CEO Diane to give us this short overview. Thank you.
Mwaramutse neza mwese. Banki ya Kigali ndi kumwe na umuyobozi mukuru wa BK Group, Madame Beata Habyarimana, na n'umuyobozi ushinzwe finance Natalie. Tunejejwe no kubagezaho uko banki na company zose zikubiye muri BK Group zakoze muri iki gice cya mbere cy'umwaka. Nkuko mwabibonye, inyungu yariyongereye ku kigero cya 24.5%. Tubona ko ari inyungu ishimishije izashimisha abanyamuryango bacu. Icyo tuvuga kuri iyi mibare nuko turebye ukuntu twagiye dukora muri iki gice cya mbere cy'umwaka, kuri business yagarutse nyuma ya COVID, n'inama nkuru u Rwanda rwagiye rugira i Kigali cyane cyane, twabonye business izamuka, ni nabyo byatumye imibare yacu mwabonye uyu munsi igaragara neza. Ikindi abakiriya bacu benshi bo mu rwego rw'amahoteli nabo bongeye gukora business ku buryo benshi bongeye kongera kwishyura inguzanyo bafite, nabyo byatumye iyo nyungu nababwiye tuyigezaho. So muri rusange dufite inyungu igera kuri miliyari 28.3, ariko ni inyungu ya banki, ya ubwishingizi, ikoranabuhanga na BK Capital byose hamwe. Tubona ko ari inyungu ishimishije, kandi iyo tureba ukuntu n'igice cya kabiri cyatangiye, tubona ko bizagenda neza ku buryo intego twari tufite tuzazigezaho. Murakoze.
Yes, murakoze CEO. Now we have some questions in the chat box that we would like to have our panelists answer. We have a question from Jackton Lawi from People Daily newspaper in Kenya, and he has 3 questions. He's asking, how has the consolidation of the more capitalized KCB changed the Rwanda banking landscape? And the second one is, do you feel like your operating costs are at an optimal level? And the third question is, how do you see BK's growth trajectory in the next 5 years? So I guess we can take these questions first, and then we'll take on the next ones after these have been answered. Thank you.
Thank you for these questions. Indeed, the consolidation of KCB Group in Rwanda, forming BPR, has brought a new player in the market, which is a formidable competitor, we believe. I think what we all want to see is further consolidation, to have larger banks that can really support the transformation of the country. So at a macro level, it's something that we welcome. We've seen in the past large deals that us only, Bank of Kigali, could not take on. So we'll be happy in the future to have better capitalized banks so we can share the risks with these banks. So indeed, I think with a new kid on the block that has a great capital strength, we expect to see competition. What we've seen in the first half is that there's been some price competition, which is not healthy, especially in a macro environment with high inflation. But from the discussions we have at the level of the Bankers Association, we want to see this smoothing out so we can remain healthy and competitive, but on the on the service rather than on pricing. Indeed, operating costs have increased significantly year on year. You might remember that we went through a comprehensive digital transformation with a migration to a new core banking system. So we saw the need to review the compensation of some of the key staff who supported this transformation. And I mean, when you look at these operating costs, a part of it is improved compensation for these key staff in IT and digital factory. But also, now that the system is live, we've started to depreciate the new system, and we have depreciation costs that have also increased significantly, leading to this more than 30% increase in OPEX year on year. But we believe that this is going to remain stable at that level, and with cost efficiencies that we're seeing, we actually believe that we'll see some of these costs reducing in the second half through the next year. So the trajectory for the next 5 years, I remain quite bullish because there are a number of projects following CHOGAM that was hosted 2 months ago. We've seen a lot of interest from investors globally to set up manufacturing plants. We actually also have an economic recovery fund now that is supporting expansion in the manufacturing and construction sectors. And some of this growth is going to be reflected already in our second half numbers. But we believe we are seeing appetite from foreign investors, local investors to expand their capabilities. And we really believe that this will also impact our growth. We also think the other subsidiaries are continuing to grow healthily. When you look at the numbers for the insurance company, when you look at BK Capital, that is growing its AUM, asset under management, by several hundreds %. We believe that we are seeing good consolidation in the financial services in the country that will benefit our company. Thank you. Maybe Natalie wants to add something, or Beata? Thank you.
Thank you, Diane. Now, let's move on to the next question. We have a question here from Juma, from Kenya. And he's asking, what is the share price at the moment? And do you think the share price is a reflection of the half-year performance?
Thank you, Juma. I believe our share price is definitely not reflecting the current performance. When you look at our book value, in the press release, you'd see that we are close to 330 francs on the Rwandan market, and that in Kenya shillings will be around 45, over 40 Kenya shillings. At the moment, on the Kenyan side, we are at around 30, and on the Rwandan side, 272, which is around price to book of 0.8. So we still see opportunity in our share price movement, and we believe it was linked to many things that were happening in our economies. You have the election in Kenya, you have the Ukraine war affecting capital movement within the continent. So we've seen low volume being traded on both markets in this current year compared to previous period and expectation. So we expect to see some price movement on the upward trend. We just are waiting to see how the macroeconomic environment will span out. Thank you.
Thank you so much, Natalie, for that response. Now, we have another question from Michel Anzaya from CEO Africa, and he's asking, how has the global shortage of commodities from Ukraine war affected the Rwanda banking sector?
Thank you, Michel, for the question. I think overall, we've seen an increase in inflation. The latest figure I saw was about 15%, which is, I think, quite unprecedented in Rwanda because we are used to an inflation rate of below 5%. Now, what this has meant for the banking sector, especially for energy prices, is that all oil importing companies have had to increase their lines to be able to import enough oil to serve the market. So we've seen all banks actually increasing the LC lines for these oil marketing companies, increasing their working capital facilities. So this has been positive for us. But on the other hand, we've seen some clients also, refraining in their investments because the costs are significantly increasing. But also this is compounded with the costs of logistics that have not really reduced post-COVID. And we see some small companies in particular that are resisting or delaying the expansion plans because of the macro situation. So I think it's a mixed impression that we have. We are hopeful, and from the figures that the central bank, the projection that the central bank has published, we expect to see inflation coming back towards the end of the year below the double-digit levels that we're seeing today, below 10%. And we hope that with strong economic recovery that we're seeing, and also things in Kenya coming back to normal and in the region, we hope to see better economic prospects, which will impact the banking sector. Thank you.
Thank you, Diane. Now, we have another question here that's from Shadrach Nyakoe from Kenya, and he's asking, are there any plans to raise fresh capital? Yes.
Thanks, Shadrach. You've seen that Natalie has presented very healthy capital levels with a capital adequacy ratio above 20%. So we don't see any needs to raise fresh capital in the near future, unless we come up with big and unpredictable expansion plans. But for now, we believe with the healthy profits we are reinvesting approximately 60-70% of our profits back into operations. So we don't see the need to raise fresh capital in the near future. Thank you.
Yeah, thank you, dear. Now we have another question here from Simon Kamuzinzi from Kigali today. It's in Kinyarwanda. I read it in Kinyarwanda. Arabaza ngo mwatubwira noneho ingaruka nziza z'uru rwunguko ni inkuru nziza kuri bande. Impinduka mwiteze ku bijyanye n'ishoramari mu gihugu cyangwa ubukungu bw'abantu. Yes.
So murakoze cyane Kamuzinzi. Inyungu twabonye irashimishije kuko abashoramari bacu bazabona iyo nyungu nabo wenda bashore iyo mari nshyashya y'inyungu twungutse mu bikorwa byabo. Ariko muri rusange nk'aba abantu bitabira serivisi za banki, kumenya ko banki yabo yunguka bituma bakomeza kugira icyizere projects bafite bakazizana kuri banki kugira ngo dukomeze tuzitere inkunga. Icyo ni cyambere. Ikindi nkuko mubizi nyuma ya COVID twagiye tubona ingendo zigaruka mu Rwanda. Hari ikigega cya ERF, Economic Recovery Fund, kifasha companies ziri mu bwubatsi, construction, cyangwa zifasha manufacturing. What is manufacturing? Inganda. Iyo fund igera ku bakiriya bacu biciye mu mabanki yabo. So ubu ngubu turahamagara abantu bose bafite inganda cyangwa bafite projects zo kubaka kugana banki zabo, banki ya Kigali of course n'izindi banki, kugira ngo turebe kuntu twabagezayo izo nguzanyo ziri ku nyungu iri hasi cyane. So dufite abakiriya benshi tumaze kugezaho iyo ERF, kandi tubona ko activities zabo zagiye ziyongera. Murakoze.
Murakoze cyane CEO Diane. Now, if we have no further questions, I think we'll be closing off this virtual press conference. I would like to thank you all for attending, for honoring our invitation. I'd like to thank CEO Beata, CEO Diane, and CFO Natalie for briefing the media on BK Group's financial performance. Now, thank you so much for attending. If you have any further questions, feel free to drop them in the chat, and then we could always respond to them after the press conference. Thank you so much.